Everyone, and welcome to their Autos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us here in the chat. And we're excited to have you guys with us here tonight. We've got a lot of great information to go over. Wonderful times in the market to be being tutored by Jeff here because lots going on. So really glad to have you guys with us here tonight. If this is your first time on, you notice that your microphones are muted. That's so we can hear Jeff and I talk, but there is a Q&A box located at the bottom of your screen. If you move your cursor around, you can put questions in there or in the chat. We'll get to those throughout the session. If you have a hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and also posted on YouTube in the coming days. So if you're watching on YouTube, please like and subscribe so you can catch all of our weekly videos as we hold these every Tuesday at 7. If you have any questions about your account, access to Trade Zillion, any open trade alerts, anything like that, email support@autostrading.com and we'll get to those sometime tomorrow. All right, so before I bring on Jeff, let me just read a disclaimer. Autos Trading LLC and Trade Zillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Autos Trading Trade Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Autos Trading LLC, including its owners, do not accept responsibilities for any decisions made by subscribers using the software, and subscribers to the Trade Zillion software or any other person to buy, sell, or hold securities should do so with caution and consult with a broker or an investment advisor before doing so. All right, with that being said, let me bring on Jeff. Jeff, you there?
I am here. Welcome.
How you doing?
Oh, not too bad. Survived another trip to Vegas.
I'm about to say, are you jet lagged or other things?
It actually does screw up your time, because we just obviously had the daylight savings time switch, and we're I don't know. Does Vegas not change? I can never remember. But anyway,
I think Vegas is on Pacific, isn't it?
Yeah, they're on Pacific. So we were, we sprung ahead, and then I had to go back to the old time again for the weekend. So it's throwing me off.
Yeah.
Anyway, that was the least of the rough part of Vegas, though. So,
well, how was March Madness? Was it madness?
It was, yeah. Crazy. It's like more and more people every year. But first year we got to actually go to a NCAA tournament game, so that was pretty exciting. Got to see UConn and Gonzaga. Gonzaga is my rival school, from Santa Clara's rival. So hopefully there are no Gonzaga people or their alumni or fans on tonight. If there are, I apologize, but I was happy to see them lose.
Yeah, it was kind of nasty, that game. It was surprising. I thought maybe they would have won. Gonzaga always kind of wins.
Yeah, UConn pulled it off.
Yeah,
Been an interesting tournament. But anyway, I'm back and hope you guys had a great weekend, a great week last week. I think we met last Tuesday, right? I'm losing track of the weeks, but we skipped, I think, the week before.
Yeah, week before.
Yeah, so welcome back. Got some things to go recap and go over from last week. Starting with our market overview, our key levels, which we've got some that we looked at last week that are still in play, and some new ones to take a look at as well. 36-month moving average as we approach the end of March. We're already wrapping up Q1 of 2023. That's also very difficult to believe, but so be it. So we'll take a look at that because I think that'll help guide us as we enter into Q2 in terms of the broader markets. And fun topic for tonight, and one that I incorporate into many of my trades. And that's how to get the options market to pay for your trades. So there's some really neat. We've covered some of them. There's different methods for doing this, but we've covered some in the past. There's some cool little tricks to get the options market to actually finance your trades. We'll talk about the various potential outcomes, but there's the potential for a number of positive outcomes. There's still, of course, risk in the trades. Not to say that we're removing the risk from the trade, but when you look at the aggregate of trades, I find that it actually, over a series of trades, reduces risk. increases profit potential. And it's a fantastic method. It's particularly if you have a smaller account, or even if you have a large account and you're just trading large position sizes, because it allows you to reduce margin requirements and amount of capital that you're tying up in a trade. And surprising that more options traders don't use this method, but we'll dig into it tonight. You guys will walk away from our session this evening with handy little tool to get the options market to pay for your trades. So again, there's a number of nuances in approaches for this, and we'll get into some of them. We won't have time to get into every one of them, but once you learn it, you have the framework and you get familiar with it, you'll figure out the different ways to do it, but we'll allude to some of those tonight. If we have time, we'll open it up to Ticker Roundtable and then wrap up with our Q&A. So welcome on, everybody. Good to see you. Good to see you, Shyam, Himanshu. Great to have you guys on. And we'll go ahead and get over to our charts and refresh for today's data. Had a nice little run up in the markets recently. Well, it's stalling a little bit. Obviously, we had the banking fiasco recently, and Fed ended up, that's right, because we met before Fed meeting FOMC last week. So Fed ended up, of course, hiking a quarter point, 25 basis points, and that I think the market responded pretty well to it. Oops, 500. I think the market responded fairly well to the hike last week, especially in the context of the fear behind the banking crisis. So overall, just kind of spoiler alert, I remain like more on the bullish side at the moment, mainly because some of these levels are holding. We actually don't have today's data yet. I'll give it another second or so here. But today, well, if we're looking at the S&P futures, I haven't actually looked since market closed what the SPX closing was, but S&P futures closed above 4,000. And I mainly look at the S&P futures for closes. But let's see. Let me give this one more refresh and see if we pull up our index data. No, we'll just hop over to our other charts and come back to Zillion. But before we do that, let's take a quick look at our market sentiment gauges. So we've got risk coming down on the volatility risk. We're just on kind of the low mid range at the moment. Trend is starting to kind of tick up. It was down in the more of the bearish neutral range recently, and we're seeing again a fairly high percentage of algorithmic buy signals relative to sell signals. We're 81% as of the close today. And we've got energy, communications, and consumer staples as our top performing sectors. Real estate, continuing to get hammered pretty hard, and likely will, unfortunately, continue to see that for the foreseeable future because of rising interest rates. Okay, so let's take a look at the SPX and get our chart up. So while we're on this is a monthly chart. While we're on the monthly chart, let's just go ahead and analyze this. And we talked about our 36-month moving average, which we look at weekly. But being that these are monthly charts, we really want to give the greatest weight to the closing of the candle at the end of each month. So of course we've got that coming up here very soon. So it's March 28th. Just got a few days left in the month. Currently, we are above the 36-month moving average, which as of close today resides at 39.4817. and we closed at 39.7127. So we're above the 36-month moving average. We're above technical bear market territory, even though we did dip into it again earlier this month. And we're just really hovering around this 36-month moving average. The more we can stay around or above it, the more it tells me we're just consolidating and waiting for a catalyst to resume the long-term market uptrend. And so there's a lot of indecision this month. If you look at the range, the high and low of, let's see, right, the high and the low of March, and then of course the open and the close, even though we don't have an official close for the month, a few days away still, but you can see that a good amount of volatility based on the high-low range, but not a whole lot of open and close conviction here. So what I'm looking at here is we opened, if you look at the range, because this range is almost certainly set now for the month. It's unlikely we're going to break out of the high and low that's already been put in place in the next 3 days. But we did open. What I look for is like, where were the open and close relative to the high and the low? So we did open in the upper half of the range, and assuming we can maintain a bullish close, in other words, a close at the end of March that's higher than where we opened it on March 1st, then that's a bullish close and would therefore also be in the upper half of the range. Now, depending on where in that upper half will give us a better idea. So we'll know in a few days whether we're going to be more likely to see an early push up in April in the S&Ps, or, you know, if something pushes the markets lower in the next few days before the month's close and we end up closing below, then we'll likely see an early push lower in April. So it's going to be really, key to watch where we close in March, since we are so close to the 36-month moving average. Okay, so let's, and of course, we'll revisit that next week when we meet again. So let's go over to our daily chart, and I'm going to go ahead and take our moving average off of here. All right. So let's zoom in a bit here. Actually, we're going to take a look at our levels. So let's kind of stay zoomed out here. All right. So futures closed today on the E-mini S&P futures. The ES closed above 4,000, but we did close below on the SPX. So that's going to be a critical resistance level to get through this week, and actually will likely tell us where we close on that monthly chart we just looked at relative to the 36-month moving average. But this is resistance. It's a millennial mark at 4,000, and we're again in very close proximity to this level. If we close above, then, like if we can break through it tomorrow and close above tomorrow, then likely we'll see that higher close on the monthly chart. And if we continue to encounter 4,000 as resistance on the SPX, then we're more vulnerable to a close below the 36-month moving average at the end of March, and higher risk of rotation lower in April. So that's really the key one to watch, starting tomorrow, if you're not already watching it, and through the rest of the week and the close of the month. 3,900 is a level of support. So if we rotate lower from current prices, watch for support at 3,900. Okay, 3,900 is very strong support. Century mark. You can see the frequency that we've encountered this level, looking at the past year. and how strong that level has served as both support and resistance. So currently it's support because we're trading above. So this is kind of our box that our volatility box that we're looking at for this week. All right, 3,900 to 4,000. So breaking through this box, SR box, I call it support resistance box, this week will give us probably the best clue of near to medium term market direction, whether it's upside or the downside. And again, we don't want to just see a break in the intraday. We want to see a close above. That's why we're looking at a daily chart, right? Because you'll see that all too often we had several over the past week, you get a break above one of these key levels, and then intraday we reverse back down, and it tracks or tricks everybody. It traps them. You see that all over the place around this level. Okay, there's breakout from the downside, then reverse lower. So if you wait for the close and you go back and look at all these, then it actually gives us a lot more clarity, right? Because this one made a lot of the move in this support resistance zone within a day, but we got the close, everyone's trapped and faked out up here, and then we got the rotation lower into support, right? And perhaps people were even faked out here. So key here is a huge percentage of traders are trapped at these key levels. And the way to avoid that is wait for the close. If you try to do it intraday, unless you're the one trying to trap other traders, and you play a false intraday breakout, which is a whole nother topic, you don't want to be the one getting trapped. So if you wait for the close, here's another fake out, break through 4,000, reversal, close lower, and there's the rotation lower towards support. Okay, so you see that all over the place. There's another one, right? There's a tiny little fake out above 4,000, close below, move right down into support. Okay, so watch out for that right now. And that's kind of actually happened yesterday. So there's a fake out. So we had a false break of 4,000, close below, and we got a rotation lower today and a close lower. But we also got a bit of an intraday reversal here on low volatility. So the range is small, and we'll take a look at the VIX. But I would just really keep an eye on that 3,900 as support, 4,000 as resistance this week. And then we're going to take a look at the VIX, which actually, let's just go straight over to the VIX right now as we're on that topic, on looking at the S&Ps. So the VIX is coming down, right? We got the VIX spike here. So actually we got, so our key level is 20, right? Which is just right about here. Right. So there's our 20 level. When VIX is below 20, as it was few weeks ago, we're looking for trade trend buy signals. So again, you can find these on the Zillion platform. And when VIX is below 20, I'm looking for these buy signals to start putting on a VIX volatility spread, basically a call debit spread, waiting for a VIX spike. I put one on fairly early because we were getting buy signals back here in January. With the VIX below 20, but I put it out like 60 days till expiration, and I ended up closing that out. Was it last week or the week before? Because I got the nice VIX spike up into the 30 level and made like a 400% return on my spread. So I love these trades. The VIX call spreads, set it up with a 5-point wide spread, and you just sit and wait, and they're a very high probability trade. The VIX is very likely to spike below 20 when we get a trade trend buy signal sometime within the next couple of months. It usually happens fairly quickly. This one took a little bit longer, but we got it. And then of course, VIX always comes back down after it spikes. So we've had a retreat in the VIX as the markets have run up the last couple of weeks. Close today was right below 20. So when we look at support on the VIX, because we are now below 20, so we did close below a support level, which is the 20 level. There's kind of a zone here between roughly 18 and 18, or roughly 18 and 19. right? So I'm watching how the VIX reacts in this 18 to 19 zone. So are we going to, bounce off 19 and start to rotate higher? And if so, then I'm bearish, near-term bearish. Are we going to continue to retreat on the VIX and we're going to break through 4,000 on the S&P? Then I'm more near to medium-term bullish. But I'm really watching this 18 to 19 zone and how the VIX reacts in that zone. Once it gets down there, if it does get down between 18 and 19, then I'm watching very closely, because if the VIX gets down into 18 or 19, then we're going to see the S&P go up this week, continue to resume its uptrend that we saw last week. But if that happens, then I want to really keep a close eye on resistance levels on the S&P. And if we get to one and we see one of those false rejections of that resistance level, I'm looking for buy signal trend on the VIX, and I'll put on another VIX call spread. And again, I use those to hedge my long portfolio, where I hold like positions in the SPY and the Qs. I use it for just a speculative trade. So I use it in lots of different ways. But it's a great way, even if you have like an IRA or some sort of retirement account where you're holding long-term positions, or you're maybe just a buy and hold investor. The VIX call spreads are a great way to hedge long portfolios, and we have a full in-depth session on those in our YouTube channel and in our members area if you didn't attend during that week. But that's the zone I'm really watching, since we did close below 20 on the VIX today, to give me guide me on what the broader indices like the S&P and the NASDAQ are likely to do. So let's take a look at the NASDAQ real quick. We'll look at the NASDAQ 100 ETF, the Qs. Now here, again, we've had a nice run up in tech, but we've encountered some significant resistance here on the Qs. And
Hey, Jeff, your audio cut out. I don't know if you can hear me or not. I just posted in the chat. Everybody else can't hear you either.
you hear me okay now?
Yeah, there you go.
Okay. Yeah, I don't know. I got
Like 30 seconds ago or so.
Okay. Yeah, I got like a weird something happened with the Zoom platform. I was like, it disconnected me, but I was still on it. It just said like disconnected. So I'm not sure what the deal is. 1 second here.
You're good now.
Let me close something out here. I've got a lot of stuff running on my other computers. So let's see if that helps it a little bit. It could have just bogged it down. Yeah, it's the gremlins. Exactly, Keith. Okay, sorry about that. So yeah, the resistance so we've encountered strong resistance on the NASDAQ 100. And I'll make this more of a resistance box, but kind of in between 310, 315 is strong resistance on the NASDAQ 100, the Qs. We're rotating lower off that. We actually did get a sell signal, a trade trend sell today, which would of course only be confirmed if the Qs come down below the low of today. So it's just at this point just a pending signal. But that's something I want to be watching. If this does trigger, then more likely we're going to see a rotation lower in tech. Let's see. Let me also point out some support, since we are moving lower off resistance. When that occurs, the first thing we really want to do is look at the closest proximity support that we might encounter as we're rotating lower. Okay, so right around 303. We've got very strong support around 295, which we're much less likely to encounter today or this week. I mean, but those are support areas I'd be watching on the NASDAQ 100 ETF, the Qs. And always remember, look at these levels and the price action around them in the context of the VIX. That's really what gives us our clue, right? So if we see VIX moving down, as we have been, we expect broader markets to move up. We expect S&Ps and the NASDAQ to move up. But you don't want to just blindly take that, you know, is what's, you know, the way it's going to be, because then you've got support and resistance. So if the VIX is moving down, S&Ps are moving up, watch for them to move into resistance. If the VIX is spiking, so this is VIX, this is S&P. If the VIX is spiking, watch for it to spike into resistance, and watch for S&P to come down into support. And that's how we time these shifts in the market. And that's the broad way we do it. To get granular, to really dig in and further time our entries, we used the trade trend momentum algorithm, because it does a very nice job at pinpointing these market shifts. So if we use this, our trade trend pending buy and sell signals, in conjunction with the VIX and S&P analysis, it's a real powerhouse. It does an incredible job. So we don't want to just only look at one or rely on one. We want to look at them in context of each other. So if we find support on the VIX, let's actually just do a little quick quiz here. So on the S&P and the NASDAQ, we just pointed out that we went up into a resistance level on both of those indices, and have taken a little bit of a rotation lower on them. But we've seen the VIX come down from its spike. So if the VIX, let me see if I have my pen out there. So if the VIX, because the VIX just closed right by support, down by support at 20 today, right? And then we identified a little bit of a support zone below that between 18 and 19. So if the VIX being down at support and the S&P and NASDAQ being at resistance, if the VIX spikes, so it goes up off that support level, off the 18 and 19 zone or the 20 level, the VIX spikes, what do we expect S&P and NASDAQ to do? You guys can put it in the chat. Yeah, exactly, Steve and Tony. Yep. So then we expect it to go down. You got it, Brendan. Yep, exactly. So we expect it to go down off these resistance levels, which it's already doing. But here's the takeaway. Be careful. You don't want to like get all aggressive on this bearish rotation lower off this resistance level yet, because the VIX is still coming down. So they haven't aligned yet. We need to see the VIX spike with this resistance level holding. Then that's where I get aggressive on a bearish play on, you know, whatever I'm trading within the indices. So if I see the VIX spike off that support and we remain below resistance on S&Ps and NASDAQ, then I can put on a bearish play. So we just don't, what we don't have right now is don't have the VIX spike. It's still coming down, which might tell us, again, I think tomorrow, we really need to wait for tomorrow to say this with too much conviction, but that might tell us that this is just a little bit of a retracement within this trend. And we could break through resistance still because the VIX hasn't spiked yet. So it's too premature. This could just be a simple retracement. So if we, again, use the VIX with these levels, that's our golden ticket right there. All right, so I'll pause there, see if there are any questions on the broader markets, any of the levels, the VIX, anything that we've talked about, and then we'll go ahead and get over into our topic for tonight.
Let's see. A few questions about the VIX, but I think you've kind of covered them as you've gone through. I'll see if anything else comes up. I'll stop you, but I think you're okay to move forward.
Okay. So I'm going to see if we got our data for today. All right, so Today, we're going to talk about using the options market to help finance our trades. And this can really be done across markets. Even you can do this to finance equity ETF purchases, which is actually a really cool strategy that we're going to get into in a different week tonight. Just to get the basics down, we're going to just stick to the options market. But if you're not an options trader, you'll want to pay attention, because it can also be applied to other markets. We can finance other trades with options premiums. So it's important to understand. But I think it'd be more practical and simple to stick to the options market tonight, and talk about how we can use the options market to finance our trades. And I'll go over some examples, and maybe we can run some scans and see if there's some example opportunities that we might be able to maybe put some paper trades in on. But the idea here is, if you take a directional trade, a directional option trade, let's say it's like a bullish debit spread, like a bull call debit spread, you're capping your risk, right, by buying and selling an option, two different strike prices within the same expiration. But you're having to pay for the trade, right? You're having to pay a debit for it. Or even just to keep it simple, let's say you're just buying a straight call option, right? You have to put out money or margin to put the trade on. Now, here's what I think you guys are going to really get excited about. What if there was a way where you could put those trades on, and even if the trade didn't work out, because like if you buy an out of the money debit spread, it actually has a pretty low probability of success, but it has a good risk reward ratio. If you put on like a 30 delta debit spread, you have a low probability of making money on that trade. But if you get the directional movement, you get the timing right, and as well as other factors, it could pay off 300, 400, 500% return, kind of like it did on my VIX call spread, right? But what if so what about the other percentage of time where it doesn't work out? Well, typically it's difficult to salvage a lot of those options trades. So if you don't get the move, you're going to lose money. I mean, there's just no way about it, other way about it. But there actually is another way about it. And that's by financing the trade by selling premium. So if the trade doesn't work out, you can actually walk away without a loss. Now, again, there's still risk in this trade. I'm not saying it's a risk-free trade, but you could actually walk away without losing the money in your spread. Okay, and that's what we're going to look at. So let me kind of show you an example. Let's actually just see if we can run a scan here on, let's get rid of forex, crypto, futures. Let's run a scan here and see if we got any. Let's do pending buys. Oops, that was sells. Okay. And let's just kind of scan through here. I got a lot of pending buys. There's one on Agilent. I know Agilent is optional. Let's take a look at the one on Agilent. Came in actually yesterday. Let's see, but it's still pending. We haven't moved up and hit the trigger. All right. All right. So in order for this to be a triggered signal, price would need to come up above yesterday's candle high. All right. But okay, I just randomly selected this, but Agilent's been in a really strong downtrend, right, since basically the start of this year. So if I were to do a bull call debit spread, I'd be trading against the trend, but I see, well, Agilent has come down into support. right around 128, and maybe it's reversing back up. And maybe there's a big payoff if I buy an out of the money call debit spread and give it some time, maybe go out, I don't know, maybe like a couple months even, and set up a bull call debit spread. Well, it's a bit of a risky trade. If I sell a 30 delta out of the money call debit spread, if Agilent continues to go down, I'm going to lose money on the spread, right? Unless we have the options market finance our spread. So the way to do that is to sell premium against your spread. And there's kind of two ways to do that. Okay, so we have, let's say we do a bull call debit spread, right? So I'll show you how to set that up, but we would want Agilent to go up. Now, if we're going to sell premium to finance that spread, what we want is because think of, if we simply bought the bull call debit spread and Agilent doesn't go up like we want, then we lose money. So we'd want to finance it in a way that if the trade goes against us, we don't lose money. So in other words, it's a hedge, right? It's a hedge. So for a bull call debit spread, we would look at selling calls at a higher price. Okay, and again, we'll look at lists in the options chain in a second. And what we're doing here is we're selling the call options to finance the purchase of the call spread. Okay, and again, we'll look at this in the options chain so it becomes more clear. You can do the exact opposite for a bearish trade. If we set up, let's say, a bear put debit spread, because we think that Agilent is going to go down, we could sell put premium at a lower price, right? And selling put premium is a bullish strategy, right? So if our bearish put spread is wrong and Agilent then reverses back up off the support level, and we finance the cost of that spread on a 1-to-1, so the premium we bring in from the put premium is equal to the premium we bring in from the spread, or the premium we pay for the spread, then we were wrong, but we lost no money, right? So that's the basic. That's the one way to do it. Sticking within the same asset. Another way to do it is to use a correlated asset. So let's say we do an options trade on Agilent, whether we buy a call or a call debit spread or a put debit spread, and we trade a correlated asset. We sell premium on a correlated asset. And this is one thing I really like to do. So Agilent Technologies, right? It's a tech stock. Maybe we want to sell premium in the Qs, correlated. Another way is we could take like if we're setting up an options trade on a stock in a certain sector. Let's say we're setting up. Let's say we're buying calls on Deere, right? Deere is an industrial sector stock. We can use an industrial sector ETF, assuming it's optionable, and we can sell premium on that, so it's correlated. And that's going to be, we won't get into that option number 2 there is deep tonight. That's something we'll get into deeper in future weekly sessions because it's a little bit more involved. So tonight we'll just stick with using the same equity, the same asset, but just FYI, that's another way to do it, and one way that I often do it. So like, for instance, I'll often sell premium on the S&P to finance my VIX call spreads that I do. So like that last VIX call spread that I bought that ended up making money, I actually sold premium on the S&P and also made money on that. So this is where it gets exciting. You can actually make more money than potentially than you did on your initial options trade by financing it, because you can make money on the trade that you're setting up, as well as the one that you're buying, let's say the debit spread, and you could potentially make money on the premium that you're selling. That's actually what happened with my last VIX call spread. I sold S&P premium and the VIX spiked. I sold way out of the money S&P premium, and I made money on that, on the decay and the S&P premium that I sold. And I also, and I closed that out long before, weeks before I actually made money on my VIX spread, because it already paid for them. So I just closed it out. I booked the premium, and then I had a risk-free trade on that VIX spread. Didn't matter. I mean, of course I wanted to make money, but even if it didn't, I wouldn't have lost anything because I financed it by selling the premium on the S&P. So that's the idea here, is that by, it's a bit more complex, but by doing this, it gives us the potential for greater profits in some instances. It also gives us the potential where if the trade doesn't work out like we intend, that we don't lose money on it, like we would have if we hadn't financed it with premium. Now, again, there's still risk in this trade. And so that needs to be taken into consideration. And that's where the trade management component of this comes in, which we'll see how if we have time tonight, but something we might spill over into next week, talking about the management of this type of financing our trades, to manage risk across the board in both trades, the premium selling trade and the premium buying trade. All right, so let's go over to I should probably pause and see if there are any questions. So why don't we do that while I'm going over to the options chain for Agilent, so we can take a look kind of how I would structure this.
Yeah, there's a handful of questions, but Steve Arena was asking, is the strategy, say, a naked one since you don't own the stock, and if you don't have enough cash in your account to cover the position, is it costly to do?
Okay, great question. I was waiting for someone to ask that. Yeah, so that's the other beautiful thing about this. It actually, it's a great strategy for small accounts, because I mean, still you have to use wise position sizing and money management. You don't want to over leverage, because again, there's still risk in this trade. But it drastically reduces your margin requirement and your cash outlay, because you're selling premium to finance the purchase of options. So yeah, the answer is it actually reduces your margin requirement, because you're also hedged the other way with your spread. If that's what we're doing, maybe we're just buying a call or a put, but you're basically, it's a hedged type of trade. So hedging reduces margin requirements and cash outlay. So that's the other beautiful thing about doing setting this up this way.
Okay. Let's see a couple more. Do you sell a way out of the money naked put or an out of the money credit spread on the ES when you trade the VIX? He said he's a little bit nervous about trading naked puts.
Yeah. So like, again, we're going to get into more of like using correlated assets for this type of option financing. But yeah. So like on my VIX trade, I think I sold like a 12 delta, maybe even lower, like a 10 to 12 delta option to finance my VIX spread. So I sell way out of the money.
Okay.
Yep.
Gotcha.
Okay. So are any others there?
Just the question is, like, are there certain stocks more attracted to the strategy than others? Or general
Yeah. So
question.
you'll want, obviously you're going to want liquid options. So you don't want to, that applies for any strategy, right? Don't trade illiquid options. So make sure there's a good amount of open interest. I mean, these calls on Agilent are liquid. If we look at the open interest here, right, we've got hundreds of contracts in open interest. So you can look at volume, look at open interest, make sure the bid-ask spreads aren't too wide. So that's, a consideration. The underlying stock, every stock's different. So just depending on when you've done your homework, you've mapped your support and resistance. Let's say that you've identify an overhead resistance level on a stock, and you're setting up a bull call debit spread, you want to make sure that you have enough room to run before you hit that big resistance level. Otherwise, it's going to make it much less likely you're going to make the move you need to make money on your call spread. So those are, yeah, some of the things to consider. So like so here on Agilent, I went out 52 days in expiration. So it's the May 19th expiration. I want to give these trades adequate time to work out. There's really no advantage to doing the, a very short-term call or put debit spread. So why not give it time to work in your favor? It doesn't mean we're going to hold this trade for 52 days. That's kind of a common misconception people will have, like, oh, I'm going so far out in expiration and I don't want to wait 52 days. I'm impatient and I want to make money tomorrow, or we're not necessarily holding this 52 days. In fact, most of these trades I don't hold for very long at all. It could be days or weeks. The VIX one I ended up holding longer, but geez, in hindsight, thank God I set that up with like a 62-day expiration, because it took, I think I closed it out maybe like 15, 20 days before expiration, but it took a while to make the money, but I did, so it's more beneficial to go further out on expiration. It doesn't mean you're going to hold the trade that long. It just means that you're giving yourself more time for it to work. And very likely we'll have opportunities to close these out long before we hit that expiration date. But I want to go out, on my spread. We'll use a call debit spread for the example. I want to go out, 52 days or so on this one. All right. So, I'm giving it plenty of time to work. Agilent doesn't have weekly options available here, so we don't really have the flexibility to do that shorter term anyway. Okay, so we selected the May 19th expiration. Now, these are going to be kind of like home run style trades. Like we're really aiming for large profit potential, like 2, 3, maybe even 400% return on this trade. So to do that, we need to go out to a lower delta. And I like to go somewhere between like a 25 and 30 delta. There currently isn't a delta within 25 to 30. So I could go with the 140s or the 145s. Right, so let's just go with the 145 strike. Okay, and again, we're looking at call options here. We're on the call side of the options chain. All right, so let me just get rid of these. So we're looking at calls. All right, so if I go out to the 145 strike, those are bid at 150, asked at 175. I like to do like at a very minimum a 5-point wide spread. This is kind of more of an expensive stock. It's trading at a little bit above 132. I may even go $10 wide on the spread. So I could go out to like 155 to sell. Right, so I could do like a 145, 155 call spread on this, and we'll see what that setup looks like here. But all right, and what we would, what that would cost us. Let's see here. So if we bought vertical 155. Let's just check this might throw us off. The bid ask market's close is very wide, but let's say this cost us, around $1. I split the natural and the mid price just because markets are closed and the spread on these 155s widen. There's still adequate open interest in them, so it'll likely tighten up tomorrow. But all right, so this let's just say theoretically, again, market's closed, so we don't have an exact price on this, but let's just say, you know, we could enter this for $1. Let's even just go $1.50 at the natural price. Okay, let's say we could buy this spread for $1.50. Right. Well, on 10 contracts, that would cost me $1,500. So you could do this with a very small account. If you could trade, you know, buy one contract, a one contract spread for $150. Right. So adjust your position size accordingly, you know, to account size, risk tolerance, etc. But that's what it would cost me, $150 a contract for this spread. So that's what I could lose if I put this trade on and just hope that Agilent went up, and it didn't. Maybe it even could go up, but if it doesn't go up enough, I lose money in the spread, right? So how can I finance this spread to where if Agilent just stays flat or goes down, I wouldn't lose all my premium? Well, we sell a call against the spread. All right. And here's where it kind of takes a little bit of playing around to figure out the math. There's not an exact formula because every situation is different based on option pricing and all these other factors. So, but I want somewhere at least around 150 in premium per contract to finance this. So this is the first step, is I pick out my options trade that I would do regardless of the financing components of it. Right. But now I know, and then you know, if markets were open and live, I would fill this spread first. So I know what I actually paid for it. So let's say markets were open right now and I paid $150, $1.50, or $1,500 for a 10 lot contract, right? 10 contract spread. Then I know what I've paid. So I know I need to go out and collect premium to finance that. To do that, I go out to a later expiration. Now, you're going to get more premium for the later expirations, right? We're not going to hold this. This is where I don't want anyone to get caught up or be like, I can't believe you're going out to sell premium so far out. We're not going to hold this premium for 143 days. No way. Like, as an example, the one that I referenced with my VIX call spread and selling S&P premium against it, I closed the S&P premium only a couple weeks into the trade. I only held the position for 2 weeks. It's all it took for me to book the money I needed to finance my VIX call spread. Every situation is going to be a little different, but we're not going to hold that for 143 days. We're just trying to get the premium because, and we can do that, geez, way down probably around an 11 to 17 delta. Very unlikely of encountering any trouble here with our selling premium out here. Okay, we're looking at much higher strikes. So, like if we sold 160, let's say even 165, right? 165. So Agilent Technologies would have to go up, you know, over 30 points for these to even start to be in the money. So we're selling further out of the money premium at a later expiration to finance. So this would just be a single leg short call. Now here again, markets closed, bid-ask spreads are all wonky. We don't actually quite have enough to finance that full $1.50. The midpoint right here is $1. It may shift at market open tomorrow and be more accurate. Here's another way to do it. Let's say we're comfortable selling the 160s. Well, our mid here is $1.92. We don't need that much money. So it doesn't have to match evenly. You want it to be at least at least the premium you're paying for your option trade. But if it's not, you can either adjust your position size, or in this case, we could sell the 160s right? So the 160s are at a 17 delta. I like to go a little bit lower than a 17 delta, but 160s, mid price, $192 a contract. So if we were just to do this on a 1-to-1 ratio, like let's say we bought 10 contracts of the debit spread, and then we sold a 1-to-1, we would collect more money than we need to make to finance the spread. That's okay. We can sell fewer. We don't have to do the 1-to-1 ratio. We could lower the number of contracts to collect the amount we need. But you want the amounts to be roughly close. So you don't want to get like creative and start, oh, I can collect $192 here, and then it only cost me $150 to buy my call spread. So that's awesome. Like even if Agilent goes down, I'm going to make $42 a contract. You don't want to do that because it messes up the whole hedge. So you want to make sure that you are collecting roughly an equal credit to the amount you're spending on your other options trade. That is critical. So don't fall into the trap of thinking, oh, I'm just going to sell more premium, make more money, so I can make money either direction. It's actually going to make it harder for you to make money on your call spread if you're selling too much premium. So that doesn't mean I can't sell the 160 strikes. I would just need to sell them at a position size, so fewer contracts to collect the roughly the same amount that it would cost me to put on that call debit spread. And now I've financed it. We're already at about an hour, so we're gonna go into the management of this and some more nuances, because I think it's a critical skill to have, especially if you trade options. But even if you trade equities, we'll also next week get into a little bit into using this approach with stock purchases. So that one example was just on a call spread on one stock. We can do the same with a put spread, right? We could do the same for just selling or buying a call, called a risk reversal. Any options trade that you're paying a debit for can be financed by selling premium. All right, so what I also want to do next week is look at our risk graphs. Because again, just quickly going back to this example, let's say this is actually kind of what happened on my VIX trade that I did. So let's say we set up the bullish call spread on Agilent at the strikes we looked at, 145, 155. And then we sell the call premium at the August 18th expiration. And let's say Agilent, which has been in this downtrend, it keeps going down. It's not, the downtrend's not over. Well, we make money on our call premium that we bought, and it doesn't take a lot of movement to book a lot of that premium, even if it's far out in expiration. So once I've paid for as much as I want to pay for my spread, I can close that out. So we don't hold both trades the same amount of time necessarily. We might, but every situation is different. There's a lot of nuances here. But let's say hypothetically, we could close that call premium we sold on a continuation of a rotation lower in Agilent. And then let's say it finally reverses off support and blasts up. Well, then we've got our call spread still on that can make money. And in those scenarios, that's one scenario of several. We can make money on the call premium we sold and the call spread. Let's say if Agilent bases its support here, it rotates higher, moves above this buy signal from yesterday. We have a triggered signal and it starts to take off. We can make money on the call spread right off the bat and still also make money on the call premium, because we were looking at a strike way up here. Oops, crooked line, 160. Look at that. I just randomly selected that, but look at the resistance there. So Agilent would have to make like a 20% move up for our call spread to even be in trouble. So let's say it just makes a nice move up into this resistance level. Well, that's a 10-point move, which is like a 7% gain from current prices, which would be a nice payoff on our call spread. Maybe we encounter resistance there, who knows? But we can make money on both the short and the long premium trades in that scenario too. So what we're basically doing is we're taking a low probability trade, like an out of the money call spread, or just buying a call would be a low probability trade, an out of the money call. And we're financing it so that that percentage of the time where we lose money on that low probability trade, which still has a high probability or a high risk reward payoff, then we're not losing our premium every time because we're financing it. So again, still risk in the trade. And we'll talk more about that and look at the risk graphs because we will spill this over into next week since there's a lot more to cover on it. But that's the basics of how it works. So a lot of information thrown at you, but we'll go ahead and take any questions.
Yeah, there's a few questions. I think some people are maybe confused with the process because a lot of them are asking questions about, well, wouldn't selling calls bump up the margin? So I don't think they understand where you're talking about spreads versus just selling a naked call that would take a ton of margin or premium for them to.
Yeah, exactly. So a couple things there. Yeah. So you're hedged, right? So margin, and there's also different types of margin accounts, right? So you got portfolio margin accounts, regular Reg T margin, different types of margin. If you just sold a naked call, yeah, very high margin requirement, but you've got a spread in there that's basically a hedge that reduces that margin requirement. But it won't necessarily be the same margin requirement as if you did like a bear put debit spread and sold a put, right? So the margin requirements differ by account type, by position sizing, by the type of the trade, all these things. But yeah, it's not like just selling a naked call because you've got a hedged call spread.
Yeah, maybe people would see it better, like if we have time to do it this week or maybe next week if it takes more time to kind of show them how it would look.
Right. Yeah. Well, that's what we'll spend time on next week and take a look at kind of the structure of it and what the risk reward graphs look like, etc.
All right. So let's see. Steve's asking, these trades, wonder if these trades connect with each other, or he's asking if they're independent of one another.
I'm assuming you mean like, so you want to put them on separately and treat them as two different trades. So again, what it tends to be kind of hard for people to grasp when they are first learning this is so many like nuanced differences of how these trades play out. It's not an exact formula. Every situation is different, that kind of thing. So there could be, if you trade this way, you see all different scenarios. I've seen a lot of them. One of those could be, you buy a debit spread, sell out of the money premium, and you get a move in the anticipated direction, and you're able to close both your short premium and your long premium at the same time with a profit. Sometimes you might have to leg out of them. You might get the move that favors your sold premium first, and you can leg out of it, sell out of that, and then hold the call spread, debit spread, for instance, for a longer period of time. Most of the time, I find that I'm legging out of these types of trades. So I'm waiting to hit a profit target on one, and then close that one out first, and then wait for the profit target on the other. So I look at them really as two different trades. And so for that reason, it requires monitoring, right? You have to keep track of what trade goes with what, especially if you're doing this across assets. Like if you're selling premium on like an industrial ETF to finance a call spread on deer, for example.
Gotcha. Gotcha.
Yeah, Tony, that's true. Yeah, the broker will take into account that you have a hedge on there. So the margin requirements do factor that in. That's exactly right.
Do you have to have a margin account to trade the strategy?
Um,
Or
well, you need to
cash
have approval to sell premium. It doesn't have to be done on margin, but a lot of premium selling uses margin. So it's kind of broker dependent and how your account's set up. But usually when people hear margin, they think of leverage. Margin doesn't have to be leveraged. You can actually under leverage margin. It just means that an amount of money is being held in your account to cover the trade. So I don't want to confuse like the term margin with like leverage necessarily.
Gotcha. I think everybody's excited about it. They're definitely more interested in seeing, maybe digging a little more next week.
Yeah. I hope you guys can return next Tuesday. Well, I just wanted to lay the groundwork tonight for the idea and like kind of what the benefits of selling premium to finance your options trades, and some of the different ways to do that and what it looks like. But this will all become much clearer because we've tonight just looked at obviously the basics and using the options chain, the expiration dates, the strikes to set those up. But next week we'll get into the risk graphs. We can set some. In fact, we'll do that. We'll set up some trades next week, and we can follow along. Follow those trades along. Just because, again, there's a lot of different nuances in terms of the trade management and even the setup that I think are really important. So I want to spend some more time on that.
Brendan has a general question. He's new to Zillion. He wants to know about the market commentary, if you post those often, or
yeah. So we post our weekly market commentary. So the session we do tonight, those get posted in the Zillion under the commentary and events if you're a Zillion member, so you can access those there, which of course contain the market commentary. Periodically, if there's something major or something that we think will benefit our Zillion members, we'll post a separate commentary. But the main weekly one is from tonight's session. We are going to actually start posting video commentaries. So in the past, they've all been written commentaries. And we're going to shortly be replacing those with video commentaries in addition to the Tuesday market overview commentaries as well.
Cool. That's all I got.
All right. Well, thanks, guys. I know it's a lot of information, but again, the recording will be available to you to review, and we're going to follow up again next Tuesday with this and dig deeper into setting these up and things like that, and the trade management part of it, which is crucial. So I hope you guys can attend next week. If not, we do have these recordings available on our members area in the Zillion platform, as well as on our YouTube channel. Thanks to all of you for all the nice comments. Thank you. Appreciate it. And plan on seeing you guys next Tuesday. Have a great rest of the week. Keep an eye on those levels we looked at tonight, starting tomorrow. And let's see how they play out when we meet next Tuesday. Take care, everybody. We'll see you soon.